What does the Fed's new enforcement action mean for your bank stocks? And why does a case involving one former employee matter for the entire sector? The Federal Reserve announced an action tied to a former Regions Bank employee. On the surface, it looks narrow. In practice, it spotlights the Fed's push for individual accountability alongside institutional risk controls. That focus shapes how banks manage conduct, lending, and consumer interactions, and it can ripple into investor sentiment on earnings quality and valuations. Here's the core idea. The Fed, as a bank supervisor, uses enforcement tools to address alleged violations, unsafe practices, or breaches of duty. These tools include consent orders, prohibition orders, and civil money penalties. When a case involves a former employee, measures often limit that person's future role in banking or remedy specific conduct. The goal is consistent: reinforce safety and soundness, strengthen governance, and deter repeat issues. This announcement lands as banks face evolving credit conditions and tighter supervisory expectations. Institutions that invest in strong internal controls, clear escalation paths, and ongoing training tend to reduce conduct risk. That can lower headline risk, stabilize funding costs, and protect franchise value. For investors, conduct and governance are not soft factors. They feed directly into loss reserves, fee integrity, and capital planning, which in turn drive returns on equity and price-to-book multiples. It also signals something broader. The Fed is not only setting rates and managing liquidity, it is actively policing standards that protect depositors and support fair lending. Even when an action targets one person, it reminds management teams that oversight must run deep across lines of business and third-party relationships. That can influence how analysts handicap risk-weighted assets, stress outcomes, and the discount rate applied to bank cash flows. So what's the practical takeaway? If you're evaluating banks, look beyond net interest margins. Scrutinize disclosures on compliance, audit findings, and remediation timelines. Favor institutions that show consistent tone from the top, timely escalation of issues, and measurable control enhancements. If you work in financial services, invest in training, document decisions, and escalate concerns early. Strong conduct frameworks are not just defensive. They can be a competitive advantage when markets reprice risk. Want the full breakdown and what to watch next across bank earnings season? Read the full article at finlitica.com. Quick reminder: this is general information, not financial advice. Your money, your decisions, so always do your own research.